Almost 2 million people traveled domestically by air over the Memorial Day weekend in the United States. And in China, flight bookings over the Labor Day holiday outstripped pre-pandemic levels. The vaccine rollout in the US and the lifting of travel restrictions proved that there is a pent-up demand among people who want to travel again. Analysts say we could see similar demand once international travel restrictions are lifted too. But they encourage caution for those who want to invest in airlines right now, because not all airlines are equal.
The pace of recovery will likely be different for various airlines. So for instance, airlines which are operating in larger countries with a sizable domestic market may fare better than those that are operating in smaller countries which depend mostly on international travel. SIA is actually in a particularly vulnerable position as it doesn't have a domestic market to fall back on. Therefore, any meaningful recovery will actually depend on how quickly international air travel can resume. And this in turn depends on a multitude of factors which are beyond the company's control, such as how quickly can the vaccine be distributed, its effectiveness in halting the spread of COVID-19, and most importantly, how quickly are countries willing to reopen their borders.
But analysts say it also depends on the type of investor. For those with a longer-term perspective in mind, valuations for many airlines are quite good right now.
Getting into a pure aviation play right now would not be an ideal scenario, unless you're willing to take a slightly long-term bet, which is at least 2 to 3 years out, and you're willing to hold on to that investment and willing to keep funding them, as we have seen in the case of SIA. Now, recovery is also not certain. We are saying 2 years out, but we know there is always a risk of reemergence of COVID-19 infection, which means there could be reimposition of travel restrictions. Oil prices are still on a rise. And you also need to keep in mind, inflation is coming back. So you will see rising costs on other fronts as well.
For local investors who want to cash in on the expected travel boom in the next few months, analysts advise looking at aviation-related plays instead of pure airlines. One such company on the SGX is China Aviation Oil.
They are the single largest suppliers of jet fuel into the Chinese aviation market. Now, if you look at the domestic traffic in China, right now it has actually exceeded the pre-pandemic levels as well. Purely because Chinese can't travel internationally, so there are a lot of people actually traveling in the domestic market, and airlines are actually competing by bringing more and more capacities on board. Now, what this means is for fuel consumption, the jet fuel demand will go up. We think it's a company that will deliver a solid 20% earnings CAGR for at least next 2 years. And keep in mind, they're a monopoly when it comes to supplying imported jet fuel into the Chinese aviation market. So once the international travel resumes, they would see a much bigger step up.
ST Engineering is another company to watch. Their aerospace division is involved in the maintenance, repair, and overhaul, or MRO sector.
Record order books, $15 billion. It's one of the blue chips that didn't slash its dividends last year. We're talking about a yield of about 3.9 to 4%, which is decent. A lot of people are worried about the aviation exposure, but its MRO business is recovering. And I think there's business on the passenger to freighter kind of conversion, and that's positive for the business. So it is one of, I think, the blue chips that's worth looking at. It is very, very, very stable. So on the investors that like defensive companies, it is one of the companies that I think they should look out for.
Analysts say for those who want to move into aviation stocks, it would be best for them to wait and see how the vaccine rollout progresses in the next few months.
If you look at airlines in general, over the last few decades, it is infamously difficult to make money. It is a very, very challenging industry. And that's true even before COVID. There's intense competition, there's no cartel pricing. Competition is a big thing within the industry. And if you look through 5, 10, 15 years, most of the airlines would probably be not great investments. And then COVID came. So I think that's a death knell for many of the weaker players. Take China, for example, the big three airlines in China, they have seen their RTK actually increase anywhere between 50 and 70%. That's big. But even with the increase, they're not making money. And that's because the international borders have not opened. So in the main, I think that airline business is still going to be very, very tough, at least in the short to medium term.
Another cause for concern is the increasing number of virus variants that have appeared recently. These second and third waves have the potential to disrupt an already fragile recovery.
As we have witnessed last year, governments can actually shut their borders with little to no warning, which will decimate the entire aviation industry. And even though I think that COVID-19 will eventually come under control and air travel will recover, the road to recovery is bumpy and is filled with difficulties. And on top of that, many airlines have actually resorted to rights issues in order to raise funds to stay afloat during this difficult period. And this could lead to possible shareholder dilution, which may have a negative impact on share prices.